Okay, so I'll straight jump into the discussion. Uh, I plan to divide the overall discussion into three parts, with the first one focusing on the social factor of the ESG, which is generally an enigma or mystery, and not much is either disclosed or quantified or discussed about it, but we get a lot of controversies from there. The second session, I want to talk about the impact investing and whether it can be the next tech investing, or it can be a sort of revolution in investing itself. And the third one is the most controversial topic in the press, is about greenwashing and impact washing. So starting with the S factor in ESG and starting with you, Muni, most of the data providers, rating agencies on ESG, I think the weightage on S is not so much. Of course, there is non-harmonization or standardization of other factors as well, but S is kind of more underreported, if I may say so. And a lot of the issues that we see these days are around uh, probably representation of the gender, or payment of living wages, collective bargaining not being there in many places, uh, human rights violations, all of that. So I want to first ask that, is this something which is ignored, underappreciated, and is it difficult for companies to follow? And is it kind of correlated with the other acronyms, that is E and G? And lastly, if a company's E is good but is S and G are not good, or if S is not good, would it still be a good overall ESG? You saw the recent thing about Mr. Musk getting really unhappy about something. So I mean, in backdrop of this, is a heavily loaded question, but I think we
Sure,
can spend some time on that
sure.
with
So
your expertise.
do remind me about questions 2 and 3. But let
Of
me
course, I
start.
will.
So first, on ESG, I've not used ESG myself because I do think that it is a classification created by buy side and sell side. And I'm not saying that ESG is a scam like Elon Musk. Far from it. What I'm saying is that the framework that was created by buy side and sell side, it was for analysts to do analysis. What it was not meant for is for companies to rearrange themselves into those three buckets of E, S, and G. So I think we just have to keep in mind that when we're looking at companies and how they're performing, we have to sort of understand that they might not be able to break it down as clearly as we would like it as analysts. When it comes to S, I do agree with you that amongst the ES, and let's say if ESG was the only framework we were looking at, S is the most probably the least understood and least standardized, measured, monitored, and reported. And there's good enough reasons for that, because unlike environment, if you look at environment, there's now global acceptance on what scope 1, 2, 3 is. There's various sort of frameworks that can help people sort of measure, monitor, and get their targets approved from whether it be SBTI or the rest. Same with governance. There's certain global standards around governance. But when you look at S, there's no global S standard. In our portfolio, for example, we have some companies that, the Nordic companies especially, when we look at the Nordic companies, they have a very low hours spent volunteering. And that's not because they're heartless, not at all. It's because over there, the social net is pretty good, because of the high taxes. So culturally, they don't feel the need to go and do or add value in the S part. So I think S is something that not only are companies trying to still get their head around what is the acceptable S, and most companies, when we review them, they delegate S down to regional levels. So MNC sitting out of Sweden can, within Sweden, do certain S, but their branch in India will be doing something different, in Indonesia, something different. So I think that's where the S part is, sorry, definitely underappreciated, underreported, under sort of measured to some extent. To your question, I think one of your question was, does it change the ranking and rating, the ESG score? So this is where I would say ESG scores are a scam. I actually think they are. The reason I say that is because if you look at, because an ESG score, most people think it's almost like saying, can you give me one healthy score? Is there a score that tells you your health is better than mine? It's not. There's no such score you can get. And in the same sense, sustainability, I think, has to be understood in the context of, let's say, the company's environment, it's in terms of its own DNA, in terms of its own exposure. It's just like individuals have to be understood. So I think ESG scores, where there's this collective one score that everyone thinks will tell you whether one company is better than the other, that is a scam. So that's, did I miss any of the questions? Because I think there was a third one.
Yes, just one thing is that whether you feel that S and E are correlated, because many times you see that poor S also results into, poor E results into poor S.
Sure, understood. Yeah. So you're right. So there's no doubt G drives it all. And what I mean by G, when I was studying at university, G was all about governance, was all about protecting minority shareholders, right? That was the big G, everything worried about minority shareholders. That now we have an augmented G. The augmented G is where you now have to protect stakeholders. And in that sense, any company that has a very good augmented G, as we call it, for us, we do not invest in any company that has not done a proper stakeholder engagement over a couple of years. That's just a rule for us. So for us, we need to have seen a very good G. That will lead to better S&E, for sure.
Great, thank you. So now we move to Ben. Ben, you have done an extensive amount of work on the coal sector, and it's basically the transition from coal and the stranded assets. This is something very important for us, all of us, because if that gets out of the hand, then we will not be able to achieve the 2 degree centigrade temperature target by 2050 or ahead of it. So, in your view, how can this be done, and it done as a just transition? Because the easiest thing is to stop some of these, coal mining activity and the power plants. But in emerging markets, particularly, they would have a grave economic as well as social consequences. So, what are the solutions towards this?
Sure, really important question, and it's a really important question for a number of reasons. One of the reasons, of course, is that to achieve the aims of the Paris Agreement, we have to phase out coal. It's really as simple as that. We need to phase it out incredibly quickly, and we can't be building new coal assets. And I think sometimes there's a bit of a confusion about what net zero entails in the energy system and across different sectors of the global economy. It means we need to get to zero pretty much across every sector we can. There'll be some processes, agriculture, long distance flying, that kind of thing, where we can't get emissions to zero yet. And that's where you net off the emissions using carbon removals, essentially scrubbing carbon out of the atmosphere. To achieve that is going to be challenging, because essentially you've got to do this transition across every sector of the global economy. You mentioned coal, and the just transition issues, the social issues. So the UK was the first industrialized economy. In 1920, we had 1 million people working in coal mines. In about 2020, the number has gone to zero. That's a 100-year transition. If you know anything about British economic history, over that 100-year period, the decline of coal mining communities, closing down coal mines, was not a simple process. It was a politically challenging process. It is a cultural thing as well, and it has long-standing, long-term issues, particularly in the communities affected. So trying to do that transition across all the sectors of the global economy in less than 30 years, net zero by 2050, is really difficult. And lots of countries have significant, just zooming in on coal again, lots of countries have very significant communities that depend on coal production, coal mining all around the world. And I don't think it's credible to think that the private sector itself can manage those transition issues. Not least because in many of those jurisdictions, it's actually state-owned companies that are doing the production as well. So there's got to be a partnership between government, between policymakers, and between companies and between financial institutions to make sure this transition is as smooth as possible. And I think there are a number of things governments can do to incentivize that, but it's got to be a partnership. And I think I'm always a bit skeptical when there's some investors talk a lot about the just transition. At the margin, I think investors can nudge in the right direction. Obviously, a lot of this is context specific, so we'd want to go into sort of more examples to talk about this further. But it's really playing around at the margin. Some of these issues are very much policy issues. They're not finance issues.
Okay. Thanks. Moving to our panelist Won on her experience in the impact investing. And Won, you told me, a week ago when we were chatting that you see that there are many social entrepreneurs, but they don't have the kind of model to scale up. That's one of the problems why social entrepreneurs are not so much thriving. Some examples I want to give you. For example, there are microcredit companies such as Tala. Then there are companies like Zipline in healthcare delivery via drones, and a company like Orcam in Israel doing work for the visually impaired. So these are some of the social entrepreneurs who have been able to scale. Given your background in tech, you also mentioned and emphasized that you are not a financial investor, and for you, you want to solve the issues with tech. So we have in the world today wicked and super wicked problems, right? So social entrepreneurship scaling up is very necessary. So how do you think they can be helped with impact investing and with the use of tech?
So for me, I just want to tell the audience here today, good afternoon, everybody. Thanks for the invitation, Jiga. Is that I'm not a finance person. I'm actually trained in psychology and worked in Singapore government as the chief of digital health marketplace and focused on philanthropy and social impact before I come into co-founding Purpose Venture Capital with my co-founder Sharon Sim, who we met earlier at 1 p.m. What I want to say is this, is that when it comes to social entrepreneurship, is that a lot of entrepreneurs care a lot about impact, about the mission, about the vision and the values. So they do not really concern themselves with about expansion of that business and enterprise. So that is why sometimes the way they craft their business model or their strategies is kind of lacking in terms of expansion and scalability. So that's one of the challenges we face when we are interacting with social entrepreneurs. But I think as a former IBMer, I'm glad to say that technology can fill a lot of the gaps that we see in a lot of the wicked problems. Let's look at the history of technology. The history of technology is about invention of tools and techniques. And the Greek word, technique, actually means art and craft. It's about crafting that technique and the tool. So with that bear in mind, and in social impact, we're really looking about the theory of change. So theory of change is really what is the positive impact you're trying to create as a result of that change. With that in mind, the technology that we bring in must be able to create a few things. So it could be the access you talk about, like access of healthcare, access of financing for the poor with little credit history, and so forth. But what is most important is that technology can also help you to not just bring people closer together, it brings new perspectives, awareness of the problem. At the same time, it can even prevent, mitigate, or treat the problem itself. So I'm going to give you 3 exciting examples as an venture investor when I look at technologies, because it's really about scalability of that impact, which is about product market fit, but at the same time that can create lots of impact across a scale that global, at the global level. So 3 examples. The first one, when it comes to prevention. I'm actually going to be a judge for tomorrow's Temasek the Livability Challenge, which we are one of the strategic partners. The first winner in 2018 is a company called RWDC. They are a biotech company that creates substitutes for plastics. So what they do is, what is exciting about a technology, which is really not very new, but what they do is that they have created something, a biopolymer material solution that is fully biodegradable in soil, water, and marine conditions with no toxic residue. Okay, so that would actually solve a lot of problems that we face with the coastal villages in Asean, right? All the plastic waste that you see that cluttered the villages and the coastal towns. But they also solve the microplastic issue that we face that could be a problem to, health, our cancer. It has been proven by research that it can lead to cancer with microplastics in our body, in our food. But what is most exciting is the art and craft. So I return to the Greek word technique. The art and craft, the beauty of the technology is that they can formulate into multiple industrial applications that can go across, all at the industrial scale. So the beauty of that is that it can be used in your plastic film in everyday diapers to your disposable straws that we have in the fast food restaurants. Another good example is mitigation, which is another finalist that we see tomorrow is a company called Red Dot Analytics. They are an industrial AI company that monitors and optimizes and controls the physical processes and systems in data centers. And we know that data centers, it consumes about 0.3% to 0.5%. It contributes to 0.3 to 0.5% carbon emissions, right? So we need to find a way to reduce the carbon footprint of data centers with the growth of digitization, especially in ASEAN. What is exciting, the art and craft of this technology, is that it has proven proof of concept and trials with the most traditional data centers. Where it makes up of the 80% of the market across the world. So if it can plug into that, can you imagine the carbon emissions can be significantly reduced? Finally, what is really exciting to me on the social impact level is modern slavery. It's a wicked problem for ages, right? Across history. Do you know that 2/3 of the victims are actually living in Asia? Forced labor, coerced marriages, sexual exploitation. Both men, not just men, women, and also children. 25 million people are affected. There's a big tech company, Amazon Web Services, AWS, and Polaris, which is a nonprofit in US. They have developed what they did, cutting-edge technology that plug into their data set that creates the largest data set for trafficking. But come on, everybody has data. What's so exciting about it? Now, the art and craft of this is just in time, real demand, right? So what the enforcement agency does really well is that they can plug into this data set across the infrastructure on a cloud-enabled model, where without any device, at any time a device, at any time, the law enforcement and agency could quickly provide real help, real rescue efforts for these victims. So my hair is standing right now because I can tell you this is the kind of technology that excites me. And if you can imagine, if I can introduce this technology to a recruitment platform, another technology company that's already supporting some of this label transactions across this region, what will be the kind of positive impact we can do?
Great. I think on that note, we'll move to the next segment and talk about whether impact investing is the next tech investing, whether it can create a revolution in investing itself. Can all investing be impact investing? Now, when we look at the different styles, and I'm turning to Munib, to you, there are, values first, value first, negative screening, positive screening. there are various ways to skin the cat, if I may say that. Now, impact investing is looking like the answer that we are trying to find out, because there is non-standardization in the ratings, and data sets and opinions differ. But in impact, you can establish that while you are trying to earn return on investment, you're also doing good, and you can establish that. So how can this be scaled? What are the challenges? What are the opportunities? What are the challenges? And is the impact weighted accounting program, which is likely to get formalized in next 1 or 2 years, will that be an answer? Can this be a panacea? Sorry,
Sure.
again, I'm throwing a lot of balls at you.
Yeah, no, thanks. First, you said, is impact investing going to be tech investing, right? The minute you think of tech investing, you think something really exciting and almost like a tech bubble, right? And I can tell you that definitely not a tech bubble, because we're here at 4 p.m., not 9 a.m. in the morning. So in the olden days, if you were a contrarian investor, you'd sort of look at it, all the companies that were the most covered and most sort of wanted, and you couldn't get a seat. You'd short that company and you'd go and buy the company that no one showed up other than yourself. So from that perspective, I think tech investing, sustainable investing, or ESG investing, or impact investing, we've got a long way to go to fill out all the empty seats that are here. When it comes to impact investing of scale, I always admire when I hear people, and get inspired when I hear stories like what Bond shared. Sadly, when you're in the listed equity space, where most of us are investing, where there's liquidity, size, especially institutional investors, family wealth managers, one thing that I advise everyone to do when you want to look at impact investing or investing in the listed space, you've got to differentiate between impact investing and investing with impact. Because to get impact investing in listed equity space is very hard. And what I mean by that is that for you to actually go to a listed company and say, by the way, I am putting human, social, environmental capital ahead of financial returns, the board, the company will tell you, you can do whatever you want, but I'm beholden to the board and shareholders. Financials come first. So I think impact investing in the very strictest sense, where human, social, environmental capital comes first and then financial returns are second, is almost impossible to do in listed equities and of scale. What you can do is you can do investing with impact. In other words, making sure that any investments that you're making, you actually know what is the impact of that. And incrementally, is it getting better or is it getting worse? And I think that is where not only are the risks for your investors, but it's also the opportunities, because there's increasingly a demand for a reduction in impact. Now, the last question, I'm very quickly going through this, and I think the last one was an impacted weighted accounting.
Yeah, correct.
Okay. So on impacted weighted accounting, I've got to say it'll be great if we can get impact weighted accounting up and running in the next decade. Just to remind everyone, if you look at financial capital, which is only one form of capital, the very first balance sheet income statement was in 1902, US Steel. In 1972, we had a globalized framework for financial accounts, balance sheet statements, cash flows, you name it. It took 70 years. That was one form of capital. We have now 3 other forms of capital: human, social, environmental capital, that companies are expected to actually formalize, standardize, monitor, measure, report. It's not going to be easy. It's going to be costly. First of all, it's going to cost a lot. And secondly, the standards are still not written properly. So from that perspective, I do believe that impact-weighted accounting is going to come, but it doesn't mean that you don't invest with impact in mind. Because even before the balance sheets and income statements were all formalized, globally standardized, people were investing in the 1930s, 40s, looking at some form of balance sheet. So I think there's going to be an interim period of various forms of impact measurement reporting on the listed space. As investors who are investing with impact, you can be smart about it and then hope for impact-weighted accounts to come through in some global format in the next decade. So that's hopefully answers the question.
Great, thank you. Juan, turning to you very quickly, in 3 minutes, can you summarize what is the best form of attracting capital for impact investments, whether these are the charities, foundations, philanthropies, family offices, social stock exchanges? Because you said that the problem is that exit is an issue for attracting impact capital, right? So, any thoughts on that? And what should be the expected rate of return on such investments?
So I think in 3 minutes is too difficult. But what I could do is sum up my personal observations and hopefully some insight perspectives for all of us to consider. Firstly, I think in order to become the next tech revolution, for impact investing to become the next tech revolution, you have to make it an economic one. One of the biggest problem for assets is because the social entrepreneurs were very focused on impact, less on the enterprise part of things. So that's the first thing. Secondly, is that the current asset structures are not very friendly to a lot of the impact investments that we see, be it from IPOs to in the acquisition space, because the fact is there's not many of these investments. So if you look at the market size itself, it's 2.3 trillion dollars in 2020 by World Bank report, and that's only 2 to 3% of the global AUM, right? So the market size itself is not attractive in terms of the deal size and the quality of deals that we see. And I remember in our conversation, you talked about what about social stock exchange? Now, in India, I think it's probable and implementable because I have done a study trip as a government director back in 2015 in Gujarat and Bangalore. I spent a month there with your offices. And I visited the quality of a social enterprises and nonprofits is exciting. It's huge, the innovation there. But then you look at established markets like Canada and UK, the UK stock exchange with that social stock exchange is only a directory, it's not trading. Ask yourself why. Why is it so hard to attract investors and capital to provide that kind of liquidity for our impact entrepreneurs? Simple reason. There was no incentive and economic reason. Beyond the public policies and incentive structures that we look at, you can try your very best, but the market must be able to be crafted, again, art and craft, right? Must be crafted in a way that can attract capital. And the best way to do that is to make it economic one. So deliver purpose and profit. And going back to the mindset of the social entrepreneurs is that as long as you are so interested in getting the funding from DFIs, the Development Finance Institutes, by the way, that contribute 30% of impact investments, but only 2 to 3% of the global AUM, right? So what does that tell you? It tells you that you have to go beyond and to attract the venture capital. You have to go beyond to attract the family offices who tend to use philanthropy as a vehicle to drive impact. So in order to do that, make it an economic one. And the approach to driving capital is a long-term strategy engagement approach that we need to do. So it's an overall ecosystem development.
Great, thank you so much. We now head into our last rounds. I first turn to Ben. This is about, rampant greenwashing incidents that we hear in the media, we see in the media all the time. And E, which is the most sort of immediate target for most of the companies. I think whether you are practicing E or not, but you have to talk about it. You have to give disclosures on your emissions. And I'm still awaiting, but a lot of disclosures on biodiversity will also be required in time to come. And there is a cost to it, whether there is a cost to it in terms of your P&L or CapEx, or in terms of your loss of market capitalization or capital cost. There is a cost to all of this. So companies give a lot of targets, but they don't walk the talk. And then it gets caught up in some kind of greenwashing or impact washing issue. So what is the solution to this? Is it that it should be in the law, whether it should be through some technology that it is captured, or some penalty or taxes? What kind of mechanism is the best mechanism to deal with this? Because it is actually giving overall ESG on sustainability a bad name. So what, in your opinion, and with a specific emphasis on E, should be addressed?
Yeah, okay. So an important question. I also want to come back to the point about impacting investing as well. But so first thing, you're absolutely right. ESG is being tarnished, has been tarnished, is tarnished. I don't think it's ever going to come back in that sense. I think it's a permanent thing. And I think this reflects a growing level of sophistication in the market and amongst clients, but also market participants and regulators as well. And by ESG, I'm sort of meaning specifically ESG ratings and ESG scores. And that's going to come under a lot of pressure, particularly regulatory pressure. I think, there's been this unhelpful conflation between ESG and sustainable investment as well. And there'll be pressure to disentangle all of these things so that the ES and G and the constituent bits are clearly defined and measurable separately, and that there'll be regulatory pressure to make sure that these aren't in black boxes and that they aren't opaque. I think one of the most important things that can be done to address this is, of course, is good regulatory enforcement, actually. And we've seen over the last few years a huge amount of effort, thousands of thousands of life years or whatever the measure is, spent on taxonomizing things and defining what's green, what's not green, and all of this in an attempt to try and tackle greenwashing. That's actually a very ineffective way of dealing with greenwashing, in my view. Much easier, much cheaper, much more effective to go, look, we're a regulator. You're claiming to do this. How are you going to substantiate that claim, asset manager? And if you can't, well, sorry, that's mis-selling. It's really not that difficult, actually, if you think about it. The sort of the questions that should be asked when products are being authorized, reauthorized. Now, I also think, and this goes back to your question, the discussion about impact. We've got, so one, we need to make sure that investing in all asset classes has some kind of impact. It can do. There are inherent limitations to what you can do in each asset class, as you were alluding to. Public markets is probably not top of the list in terms of the impact that you can have. But I think investors need to think about what impact they can have in each asset class, and they need to maximize that impact. And that requires some intentionality. It requires a strategy. It requires governance. It requires resources. It requires a theory of change. And this is again, it's not rocket science, but at the moment, very few financial institutions are really thinking about how they can make the world a better place, actually. And I think your regulators will also move I think in this area. So, for example, if you pick up some fund documentation and it says, well, this fund invested in MasterCard and therefore you helped X million people, get access to the banking system. You owning the stock of MasterCard did not do that. Let's be completely open and honest about that. And the thing that's missing is if the investor did have a role in encouraging MasterCard to do something that made a difference, then you can make that claim. But very few investors try and join the dots. They spend a lot of time trying to measure the impact of companies that they own, but they didn't have actually any role in enabling that impact or contributing to that impact. And I think regulators will clamp down on that, because that's making misleading claims. And if you can't substantiate your claims, you're going to be in trouble.
Right. And one quick question in the end for you again, that when we see the overall issuance of the sustainable and green bonds globally, it's about $1 trillion market today, but very little capital is being attracted in Asia, and even more less in the ASEAN. So you are associated with the Center for Greening in UK, greening the finance. So what's your thought on this? How can ASEAN attract more capital for sustainable finance?
Well, I think ASEAN should be, and Singapore in particular, should be the leading center for raising transition finance, and by that I mean sustainability-linked instruments. So you change the cost of capital for the issuer or the borrower based on that issuer or borrower meeting exceeding or failing to meet sustainability outcomes. And changing the cost of capital for borrowers and issuers will incentivize them to change their behavior and can make a big difference. And this is a very nascent, rapidly growing, but very important area. I think it connects the dots between some of the rhetoric and actually making a difference. There's some issues with it at the moment, particularly around the KPIs and how you pick the right KPIs and how you link them to incentive structures. There's a lot of opportunities for innovation. I mean, I think the green bond market's obviously been developing quickly, but again, I don't think green use of proceeds instruments structures have much of a future looking ahead, because they don't really have any impact. It goes back to sort of this impact washing. Oh, I've issued a green bond. Oh, I've invested in some green bonds. Well, okay, well, what difference did it make? Now, if you've got a well-designed sustainability-linked instrument, that does make a difference. You can substantiate the claim. And in addition, have actually made a difference, made the world a better place, right? Which is ultimately what a lot of us want to do, even if that's not the primary purpose for some. So,
Great. I think we have 5 minutes to take questions from the audience. And I have some questions here already. Starting with Ben. There's a question. Can I ask Ben how carbon credit offset can help with or complement the ESG effort?
yeah, absolutely. So, a carbon offset, when it's a sort of high integrity offset, and we can come back to what that might mean, essentially is creating a cash flow for something, right? So you're creating a cash flow, you're remunerating an activity that's making a difference. Now, some offsets don't make a difference. They're problematic for a bunch of reasons. But if you're looking at the sort of the highest quality offsets, carbon removals of various kinds, and Singapore has been world leading in developing markets in this area in a way that's unique, because you've got this sort of ecosystem that's nurturing itself, and with the support of the regulator and the government. I think that's very impressive. That creates a bankable, investable cash flow, and we need more of those. Obviously, we need to create forward price curves. We need to create these markets in the future. But that's how these things make a difference. They create cash flows for the things that need to happen.
There's another question for you. That given the developed countries are the highest per capita emitters, shouldn't they be doing more for the environment? For example, the SUVs in US are giving like an average fuel efficiency of 7 liters. I mean, that's a kind of poor mileage that is there.
So obviously, yes, they should. Everyone needs to be making a very significant difference. Remember, to stabilize temperatures at any level, not just 1.5 degrees or 2 degrees, but also to stabilize temperatures at 3 or 4 degrees, you need to achieve net zero at some stage. And to achieve net zero means reducing emissions to zero pretty much everywhere, and then netting off some stuff with some of the residual emissions with carbon removal. So I think embedded within the question, maybe incorrectly, I'm misinterpreting it, is this idea that the developed world needs to sort this out first, and then emerging economies can follow. I'm afraid everyone's going to have to do it at the same time, otherwise we're all stuffed. So having this kind of fight about, well, the Americans have still got SUVs, and therefore we aren't going to do anything until they get rid of them. That's a lose-lose scenario for us all, I'm afraid.
So now a question for you, Munib, from the audience. What is the best ESG stock to buy in ASEAN?
Great question.
So before I answer that, and I'm going to think about that, before I answer that, one clarification I do want to make, and if I sort of, I don't want to leave everyone with this thought, and thank you, Ben, for sort of maybe pointing it out, that I wasn't saying that listed companies cannot have an impact. Sorry. What I was implying was that, or suggesting, is that the impact that you're expecting from companies that are listed is a different impact that you would get from unlisted ones. If anything, listed companies, because they are so big and they're multinational, if they do make an impact, the scaling up of that impact is very quick and can be very big. So from that perspective, I do think that one should know that listed equities have a lot of potential for impact. ESG stock in ASEAN. Whoa. Why don't you go to Von first and I'll come back?
I'm happy that I'm a moderator.
I'm actually very curious when you have the answer, please. Thank you. So for me, I think, well, again, I'm not in public equities. What I'm most interested is what would make me the healthy returns, but at the same time, I can distinctly see that the products and services has a direct impact. So I play it safe. I go to biotech and health related types of equities because I can clearly measure it and look at that. And of course, because of my former digital health marketplace background. Yeah. You can connect with me offline. And I did manage to exit as I told you, my company that was listed on NASDAQ was a biotech company. So, so I'm very grateful for that. That's it. But at the same time, it's really difficult to measure if you cannot see the direct impact.
Fair enough. So I think we are almost out of time now, and I'll use the last 1 minute to summarize my takeaways from today's discussion. So I think when it comes to the S factor, which is a sort of mystery or enigma within the ESG, what our panelists are trying to suggest is that it took the financial accounting to develop almost 7 decades. So if the impact weighted accounting develops in a decade from now, that will help us standardize some of these disclosures. And it's definitely not as easy as in the G or E to develop the standardization of the ESG data. So therefore, I think the S factor to get standardized will have to wait. The second aspect about the scaling up of the impact investing, it needs a better ecosystem and it needs more commercial approach for social entrepreneurs to thrive. And last but not the least, on greenwashing and impact washing, we probably need more of the regulation and law enforcement rather than a lot of multiple taxonomies and compliance, which is only done by the uh, investors. But we need more regulation and more strict enforcement. So with that, I think we end this session. And thank you so much for all the panelists for their expert views. And it was a very enriching discussion. Thank you so much for that.
Thank you. Thank you for having us.
Thank you, Jiga, Vaughn, Ben, Munib, for your special insights and takeaways. We're almost at the end of day one, but before we break for networking and drinks, kindly be reminded that day 2 session will begin at 9 a.m. SGT, Singapore time, tomorrow, and that all sessions will only be available through Zoom. For more information, you may access the event schedule on Maybank's LinkedIn page, or I think there will be a QR code that will be that has just been flashed behind me. Last but not least, let me now invite Maybank Securities Singapore CEO Aditya Leroy to come up and make his closing statement for the day. Aditya?
All right, I'm the last act for the day, and I'm your last host. But I don't think I could have let all of you leave without a proper thank you. We thought we were brave in hosting this and embracing the Singapore opening and having a live session, but it's truly bold of all of you guys to come, all of you people to come, join us, supporting Maybank. So a heartfelt thank you, panelists, clients, partners, and Minister Alvin Tan. Without him, this event would mean nothing. 2 minutes of my summation of today's events. I think the morning session pretty much confirmed we live in a complex world. Some of the old assumptions and conventions of a bipolar or a unipolar world probably doesn't hold true anymore. For investors, for our clients, and even for some governments, they have to find a way to exist in this new world order of a multipolar existence. But as this rebalance happens, there's still a lot to be excited about. Our afternoon sessions talked about there is still opportunity. It's a hard time to think about it, It's a hard time to see it, but there is a lot of opportunity in the ASEAN world. We're still seeing a lot of growth. We've got accelerated digitalization after the COVID pandemic. We've got increase in affluence and wealth happening in this part of the world. And the professor talked about the fact that there could be and is happening of relocation of supply chain from North Asia into ASEAN. In our afternoon session, in our session with Munib and the team, we talked about that investing in people and investing in environment is not mutually exclusive to investing in your investors and shareholders. Our session around women in finance or women in fund management, we talked about or brought home the point around embracing diversity and inclusivity. And it couldn't have come at a more interesting time, as Audrey tried to talk about. The ASEAN landscape in itself is at the cusp with a higher participation of women in the labor force, and it's expected to add, that consumption is expected to add 3 trillion in additional consumption value by 2030. So it's a meaningful thing to embrace and something we need to look at. But Singapore itself is at the cusp. Minister Tan talked about the fact that we need to do our part. So for all of this real value to have some realization, I think Singapore will need to play its part as the regional hub in bringing some of this value into our ASEAN world. Maybank Singapore, one of the oldest regional banks in Singapore, Maybank Securities, ASEAN's investment bank. We are here. ASEAN is our home, and we will be with our clients and our partners, helping you navigate your ASEAN journey with us. Thank you, everyone, and I wish you well. Thank you for being with us today, and I now welcome you for drinks in the foyer outside.